Exchange-traded funds, or ETFs, are one of the most life-changing investment products ever created for individual investors like you and me, because they allow everyday people without tons of money to invest in a diversified portfolio of stocks and bonds and become financially successful. But what exactly is an ETF, and how can we start using them in our own investment portfolios? To understand what an ETF is, let's first break down its name. An exchange-traded fund is exchange-traded, which just means that it's bought or sold on a stock exchange. This really just means that it's as easy as buying or selling stocks or bonds, unlike something like, say, real estate that you typically have to buy directly from the seller. Then there's the F in ETF, which stands for fund, and whenever you hear the word fund, it just means that a bunch of investors are pooling their money together to invest in something. This is true for hedge funds, mutual funds, and of course our exchange-traded fund. So that explains what an ETF is at a high level, but what is the fund actually investing in? The answer to that depends on which of the thousands of ETFs out there that you're actually investing in. Each ETF has its own focus, with some focusing on certain industries such as healthcare and tech, while others focus on strategies like fixed income and dividend payments. Then there are some that focus on only commodities like gold and silver, and there are some that focus on real estate. There's really a ton of different options to choose from. But the most popular ETFs are the ones that follow certain indices, such as the S&P 500. The point is that all these ETFs are investing in a specific focus area, and by investing in these ETFs, you're also investing in that focus area. Just to make sure things are clear, let's go through a quick example. Let's say you've done your homework and you know that you want to invest in the S&P 500, which consists of 500 of the largest US companies. You could go through the painstaking process of buying all 500 of those companies in the right proportions and managing their balances every day, but a much smarter approach is to just invest in an S&P 500 ETF, which will do all the hard work of investing in those 500 companies for you. But how does an ETF actually make you money? There are two main ways that your investment can grow in an ETF, which are market returns and dividends. Market returns are when the price of your ETF investment goes up between the time that you bought it and the time that you sold it. Let's say that you have an ETF that holds just Microsoft, Apple, and Google. When the collective price of those three companies goes up by 10%, the value of your ETF will also go up by 10%. Your ETF investment can also go up in value when the underlying assets pay interest or dividends. Many companies distribute a portion of their profits to their shareholders in the form of a dividend, and that money can be pocketed by US cash or reinvested into more shares of the ETF. Now, while market returns and dividends are great, it is important to understand that all investing has risks. An ETF's price will fluctuate day by day, and it's not uncommon to go through long stretches of time where the investment has gone down in value, so you need to make sure you're investing in something that has a long track record of success. The other concern to consider with ETFs is their expense ratio, which is how much the company that runs the ETF is charging the investors for this service. The best ETFs have a very low expense ratio, I'm talking less than 0.25%. But there are a lot of ETFs out there that charge really hefty fees above 1%. Which is a lot when you consider that that's taken out of your return every single year. If you want to avoid these high fees and risky ETFs, I have some ETFs that I believe are great investment options for beginners, and I'll show you exactly how to invest in them. First and foremost, you can't go wrong with an S&P 500 ETF. These ETFs aim to invest in and match the performance of the S&P 500. And they're the most popular ETFs to invest in for a good reason. These S&P 500 ETFs are really well diversified, typically have very low expense ratios, and have a very strong track record of success. I personally invest in VOO, which is a S&P 500 ETF run by Vanguard, but any of these other options are honestly just as good, since they're all basically the exact same thing, just run by different companies. If you want something a bit more specific, you could go for a sector ETF, which follows a certain industry. I know a lot of people like to focus their investments on the tech sector in particular, which is not something that I personally do with my money, but I totally get it when you consider the strong historical performance that the tech sector has had. If this sounds like something you're interested in, the QQQ ETF tracks the NASDAQ 100 index, which holds many of the world's leading technology companies such as Apple, Microsoft, and Google. If you don't want to be entirely invested in stocks, you could also consider diversifying your portfolio with bonds. Bonds have their own pros and cons to consider, and they have lost a bit of their popularity in recent years due to rising interest rates, but I still see bonds as a good way to diversify your portfolio and protect yourself from some market fluctuations, especially if you're near retirement or already retired. Vanguard's BND and Fidelity's FBND are both solid options for bonds. Lastly, if you want to invest in real estate without the crazy high costs of buying a home these days, a real estate ETF such as VNQ is a great way to get real estate into your investment portfolio. This ETF invests in REITs, or real estate investment trusts, which are basically companies created solely to buy and sell real estate. But although real estate has historically been a pretty safe choice, it's pretty clear to me that companies still haven't really figured out what to do with all their office and commercial space, especially with people working from home nowadays and not going out to shop as much. Still, if you believe in real estate, then this ETF could be a great option for you. With that said, let's jump right into how to actually invest in these ETFs. Since they trade like stocks on a stock exchange, it's actually really simple. I do my own investing with Vanguard, but for this example, I'll just be using Cash App because it's really easy to show you how it's done. All I'm doing is going to the investing page, searching for the ETF, which in this example will be the S&P 500 ETF VOO, putting in how much I want to buy, and that's it. In just a few easy steps, I'm now invested in an S&P 500 ETF, which is a great option for beginner investors. If you want to learn more, check out this video covering index funds and whether they are or aren't overrated.